Good afternoon, everyone. Thank you so much for taking the time to be here with us today. Welcome to our webinar on life insurance basics. This webinar is part of the Financial Literacy Month in Canada. This is the second year we're doing an initiative for the Financial Literacy Month. So all throughout November, we'll be having different webinars on different topics about financial planning, investments, anything financial literacy related. So my name is Corinne Sauvé-Boulé. I'm a portfolio manager and financial planner at Demas Family Wealth Management. We're a part of Raymond James. And I'm here today with Marc-André Turcot. Hi, Marc-André.
Hi, good afternoon.
Who's also a portfolio manager and financial planner in our team. And I have the great pleasure to present to you Jordan Steevensz. Hi, Jordan.
Hello, thanks for having me.
Who's going to be presenting today and who's also part of our wonderful team. So just before we go ahead with the presentation, a few reminders. So this presentation will be recorded. We'll be sharing the recording by the end of November for those of you who would like to see it again or maybe share it with some people you know. And then the other thing I would like to mention is we really invite you to ask questions throughout the webinar. You can ask questions using the Q&A box at the bottom of your screen. Your questions will be anonymous, so feel free to ask away. All right, so Jordan, go ahead.
Okay, thanks very much, Corinne. Thank you, everybody, for tuning in this afternoon. We're live from Old Port, Montreal, Quebec. It is Friday afternoon, and today we're going to talk about life insurance basics. As Corinne mentioned, this is Demos Wealth Management, Family Wealth Management, and this is for our Financial Literacy Month 2024, also respecting Movember, as you can see. My name is Jordan Steevensz. I don't always look good, but when I do, I make sure a professional photographer is around to take photos of me. As Corinne mentioned, I am an associate portfolio manager as well as a financial security advisor here at Demos, and very happy to be part of the team. So I'm going to get right into it and manage your expectations. Today's agenda, we're going to talk about first, what is insurance? How does it work? What is life insurance? Why you should get life insurance? Term versus perm, and don't worry, I'm going to explain what that is. Single life versus joint first to die versus joint last to die. Quick little explanation of the difference between those and when we would use different policies. What is disability insurance? What is critical illness insurance? A final thought from myself, the presenter, and we'll end with a Q&A. And of course, the autograph session has been canceled as this is a webinar. Okay, so what is insurance? If I could break it down into two words, it is spreading risk. Now, what does that mean? It means that insurance takes the risks of many individuals, combines them, and spreads that combined risk among an entire group. Now, this concept isn't new. In fact, as early as the 15th century, merchant sailors would distribute their cargo among several ships rather than consolidating it all onto one. That way, if a ship sank, they'd only lose a portion of their shipment rather than the entirety. So let's say I'm a shipper. I've got 4 buddies. We each split 20% between the 5 ships. If one ship sinks, we only lose 20% each, as opposed to if I had my own ship and all my cargo on the one, I would lose everything. So we're just spreading the risk. Now, this same principle applies today with modern insurance policies, except instead of cargo, we're insuring people's lives and cash flows and such and such. So how does this work? The insurance company will take the risk of many people that have the same risk profile and then collect premiums, reinvest those, and then pay out insurance policies, essentially. The big part of this is what's called underwriting, in which the insurance company assesses the risk of the individuals they're insuring. So there are several key factors that will impact their underwriting decision, and that is principally age and gender. The older you are, statistically, the closer you are to death, which means the premium is typically going to be higher. Men tend to die sooner than women. So for life insurance, our premiums are just typically higher, and I'll show you some stats on that later. Personal and family health history. Obviously, if you've had a life-threatening disease like cancer, that is going to impact your life expectancy and therefore how the insurance company is going to view you as a risk. Smoking status, obviously, it's very common amongst North Americans. This has a very big impact on your life expectancy and also just your quality of life. Smoking is also linked to heart attack, heart disease, and stroke. So these are all factors that contribute to you being a higher risk rather than a lower risk. And obviously, employment and income levels will impact that as well. Let's say a janitor, we probably can't insure for $2 billion, using an exaggerated example, but there has to be some sort of alignment with the value of the income attached to that person. So again, the insurance company will repeat this process many, many times. The textbook actually tells you to think of it as, imagine you have 1,000 people who graduated high school the same age as you, who have the same profile, et cetera, et cetera. Some are smokers, some are less healthy than others, some have health diseases. Where do you fall in that? And basically, some of us will die earlier, some of us will die later, and the insurance company is basically playing the odds. So, what is life insurance? For you word of the day fans, what is an aleatory contract? It's just, as my fourth grade teacher would say, a $10 word for based on an unknown event. Okay, so that unknown event is the death of the life insured. We don't know when it's going to happen, but it is going to happen. So, on death of the life insured, a tax-free benefit is paid to the beneficiaries. And so, to understand an insurance contract, we have to understand who the parties are to that life insurance contract. So, first, we have the policy holder. As a person who buys or owns the policy, they have the ability to make choices regarding the policy, like who is going to be designated beneficiary. And then they are also responsible for paying the premiums. If they allow the policy to lapse, coverage will end. So that's a big, important part of the policyholder's job. The next party would be the life insured. That is the life that's going to trigger the death benefit. So the person who dies, it's then going to trigger the payout from the life insurance company. That can be the same as the policyholder. It isn't always, but depends. And finally, the beneficiary. So that's the person who will receive the death benefit in the event of death. So if I could use a really quick example of myself, I'm going to buy a policy on my own life, and I'm going to make my girlfriend, who's buying a condo together, the beneficiary. So I'm the policy holder. I can make decisions. I've decided she's going to be the beneficiary. I have to pay the premiums. If in the future I were to die, it's going to trigger it. So I'm the life insured, and my girlfriend would be the beneficiary, the one who's going to receive the death benefit. Okay, you can use any number of combinations for this sort of thing, just to understand how the contractual relationship exists between these three parties. So there are temporary and permanent life insurance policies, which we're going to explain a little bit later. What I'd like to draw your attention to is a very poignant phrase coined by Benjamin Franklin, which is, in this world, nothing can be certain except death and taxes. When I was in paralegal school, I worked for a real estate lawyer, and he said, you need to learn tax and you need to learn inheritance law, because there will always be rich people who want to give their stuff to their loved ones. He said, you never go out of work. So to that point, it's a great segue for why you should get life insurance. There are several financial impacts that result from death, and we don't always think of these things. But first and foremost, a loss of an income. Now, think about a household where there's a particularly higher income earner. This is a bigger risk if that person were to die prematurely, because your cash flows and standard of living will be definitely risked. So life insurance can be used to manage this risk. The flip side of that is the loss of a caregiver. So let's say you have a stay-at-home parent. There's still a cost to losing them, whether or not they're generating revenue, because the surviving parent will either have to stay home more with the kids or pay for childcare fees or whatever the case may be. In the end, there is a financial impact to losing that person. Debt repayment. As I alluded to before, I'm moving into a condo with my girlfriend for the first time. We now have a huge debt in the form of a mortgage or hypothèque for our Québécois, and we can manage this risk. Even if both members of the household are earning exactly the same income. If one were to pass away, the living expenses would double essentially, because one of our contributors is gone. And then any shared expenses of food and stuff will also pile on. So this is a big impact where there's a big debt outstanding. And again, you can manage this risk by putting in place life insurance. Income taxes. On the death of a taxpayer, there is a deemed disposition. With extra properties, let's say a intergenerational cottage. Sometimes we have huge capital gains on a property that can't be sheltered using principal residence exemption or anything like that. So we can hedge this using life insurance because, for example, if you got a cottage in the 80s. We're now 2024, 45 years. Maybe it was $100,000 then. It's worth a lot more now. The government's going to want its pound of flesh, and we can plan for that when it eventually passes from mom and dad to the next generation. Estate
Jordan,
creation. Yeah,
sorry to interrupt. Maybe for those the people that don't know what deemed disposition mean, would you care to just explain it a little bit?
sure. So basically, upon the death of a taxpayer, the government assumes a deemed disposition. It means they assume that all of your assets and capital have been sold at fair market value, and then you bought them back the next day at that price. So there is a tax liability that's created, even if you don't actually sell these assets. But again, the government wants its pound of flesh, and so we need to manage this. This is mitigated a lot on the first death because with spouses, we can roll registered accounts and the principal residence. When you have extra properties that don't have this benefit, it becomes an issue. So intervivos giving is a way to get around this where you give to the next generation and then it gets taxed at that point. If you wait until death, like I mentioned, dad dies, then mom dies, there is eventually the tax that needs to be paid when it passes to the kids. So we can plan for this sort of thing, matching kind of your duration of when it's going to be consumed. So I sometimes think of life insurance as a bond, except our maturity date is unknown. But if we know, for example, we're going to be hit with this tax, I use the cottage as a very common example. A lot of Montrealers and people from Toronto and Muskoka and Tremblant, et cetera, they have that second property, and we're not thinking about it, but it's there. So there's a huge tax liability, again, on the deemed disposition at death.
Thank you.
So education funds, obviously, estate creation and education funds are kind of along the same vein. I think this more as young couples who just have a first generation of kids, don't have a lot of assets. Maybe most of their money is tied up in the house. This is a measure that you can make sure the kids are provided for their education, as well as creating an estate when you have very little assets. Can be relatively low cost using insurance. Legacies is along the same vein. Charitable giving is also very interesting in certain cases. If you donate a life insurance policy, it is actually eligible for the donation tax credit. You can claim up to 75% of your income and 100% of income in the year of death. So using life insurance policies can get a little interesting. My colleague, Annie Belanger, is going to do a webinar on corporate-owned policies and post-mortem tax planning, which is very important for business owners, which leads nicely to this last point here, business continuation. We mentioned deemed disposition, but when there's a business owner, there is the potential for triple taxation, which is the need for post-mortem tax planning. And what that is there is a deemed disposition, which affects the taxpayer on their terminal tax return. Then there can be tax on the corporation when it's selling assets, and then also again when it's distributing assets. So if you don't have the right planning in place, this can be very onerous for the taxpayer, and this is the type of thing we want to avoid. But again, Annie will touch on that on Monday to the 21st, and we'll move on here. So why you should get life insurance part 2. These are the real highlighted points I'd like to emphasize here. It's a tax-free death benefit, meaning that it goes straight to your beneficiary's pocket. So let's say I had 2 children. I have $1 million of coverage. They're each going to get that $500,000. Any subsequent investment they do of the funds will be taxed, but it's not going to go on their T4, so to speak, and it's not going to get cleaned up on the way to their pockets. The other key point there is that they have complete discretion on how to use the money. Now, if we're dealing with minors, you might have to do a trust, in which case you have layers of a little bit of planning and controls there. But the key part here is that you can decide how that money gets used thereafter. It's not attached to anybody or anything. Another point here is that it bypasses the estate. So for common law provinces, your estate gets consolidated in value and then a percentage fee is charged on it, basically. That does not apply in Quebec, but for the rest of Canadians, this is particularly pertinent. Insurance proceeds do not pass through the estate, which means they're not involved in the probate calculation, which means just less money that you pay to the government. And there's a little bit of an infographic I'll show a bit later. It's creditor proof. What that means is that if you have debts, these creditors cannot get to the insurance proceeds. It goes strictly to the beneficiaries. You do need to make a designation to a protected class. So that's your spouse, children, sibling, or parent. You have a certain protection there. But if it's to a third party or not protected class, if you make an irrevocable beneficiary designation, you do have that creditor proofing. It just becomes a bit difficult to administer the policy potentially. It also creates liquidity on death. It sounds bad, but it's nice to have some money at that time. It's a difficult period for the family emotionally, and then also the costs of administering an estate can be very expensive. It might also allow you to keep certain sentimental assets within the family, as opposed to liquidating them to pay those deemed disposition and tax liabilities resulting from death. So again, with business owners, that's very important to buy back private shares, for example. If there is the premature death, your investment is in the money, for lack of a better word. I don't mean that pejoratively. I just mean if you're only 2 years into a term policy, for sure it has paid out more than you paid in premiums, for example. So you do get a return, if you like, on that. And the flip side is if there isn't premature death, you still do have that peace of mind knowing that there's a little bit of a payout coming to your loved ones in order to help set them up.
Jordan?
Yeah.
Going back to the probate fee, correct me if I'm wrong, but in order to bypass the probate fee, you need to name specifically a beneficiary and not the estate, right?
Exactly. So if you do have a policy in force, you definitely want to look at that. You do not want to make the designation to the estate. You definitely want to name the beneficiary specifically in the policy. You could also mention it in the will. I'm following the designation that I've made in policy XXX to make sure there's certainty. The other thing you can do where there are minor beneficiaries and you want to set up a trust, you're going to make a separate trust document aside, and the insurance proceeds where it's going to a minor to a trust needs to be payable to the trustees, not to the minor beneficiaries. So then the money is then put in the trust where the trustees administer the account pursuant to the terms of the trust and distribute the assets to the minor beneficiary later. But that's a very good question. Definitely have a look at how you're designating and make sure it's not directly to the estate, or else you're going to kind of lose that benefit. So very good question, Marc-André.
Yeah, I would even add that if you don't designate anyone, it's the default option is the estate. Yeah.
Very good point, Corinne. Very good point. So now we're just going to quickly get into the advantages of term, as in temporary versus permanent policies. So temporary insurance, the coverage will end on a certain date. So if I take a 10-year policy today, November 15th, 2034, my coverage is going to end unless I renew. So let's say November 20th, 2034, if I die, my coverage will not protect me. So temporary insurance is appropriate where you know the end date where coverage will no longer be required. Let's say I want to leave a gift for a child, but I'm also saving on the side. I think it's going to take me 10 years to reach that savings goal. If I get those 10 years, I'll be okay. You might just manage the cost of your premium by using a temporary policy as opposed to a permanent one, which would be much more expensive. Permanent insurance is coverage that never goes away as long as the premiums are being paid. There are 3 types, which I'll briefly discuss. It's just T100, whole life, and universal life. If you do not know the exact date when the insurance needs going to leave, it's a permanent one, and then you want to protect it or hedge it with a permanent insurance. So the advantages of term insurance, it has much lower premiums. So again, in terms of budgeting and cash flows, sometimes you need to go with permanent until income catches up, and that's perfectly fine. A lot of term policies also have what's called a conversion. You can flip it to a permanent policy later when cash flows are more permissive. You also just lock in your coverage at the health level you have now. So let's say I take a term 20. If I want to convert to a permanent, let's say 15 years down the road, I can do that and I don't have to provide further medical evidence. So I've locked in a contract with the insurer. If you flip to a permanent, there is a fee to pay. There's original age conversion and attained age. We can get into that later, but basically you can flip it, just your premiums will increase because it's permanent coverage now. It's very easy to understand term. You get coverage for this amount of time. If you die within that period, you get a death benefit. You don't. Premium will never increase, so you're fixing your cost. And the coverage can be customized, as I mentioned, with those convertibility options, and it can change as your needs change. So the disadvantage is, as I mentioned, it's pure insurance. If you don't die during the term, and you don't renew, you're not going to get any financial payout unless you die. At the end of the term, as I mentioned, the coverage ends unless you exercise an option to do that. The other issue is it has no cash value during the life of the term, or excuse me, no cash value during the term of the policy, meaning you can't pay in 5 years and then get something out of it. That's only for permanent policies. So that's one big disadvantage of temporary ones. So permanent, there are 3 types. I'm not going to spend too much time on them because they can get a bit complicated. So term 100 is the least expensive, least complicated. It's quasi-term in the sense that there is no cash value, just like temporary policies. You pay a premium till 100. If you haven't died yet, the policy's paid up. And then the amount of coverage is kind of set. There is no potential growth in it. Whereas with whole life, which is the next one, it's a little bit of a mid-level. Whole life offers lifetime coverage and guaranteed premiums and a guaranteed cash value component that grows, albeit at a conservative basis over time. This is often chosen for long-term financial planning, providing both death benefit and potential for dividends. So there's different ways you can use the investment portion of those types of policies. You can use it to pay your premiums. You can use it to buy more insurance. It's more customizable. And then the final one is universal life. This is the most flexible and most complicated product, and obviously it's the most expensive if we're going from top to bottom. You can adjust when you pay premiums, how much. You can even change, in some cases, who the life insured is. You also have more control over the investment sleeve of the policy, if you like. And you can also minimally or maximally fund these policies. Some business owners use these kind of as a corporate TFSA. It's very interesting. Again, Annie will get into greater detail about this, but again, this is going to be your most expensive type of products, so it's not always appropriate for everybody.
Jordan?
Yes, sir.
We have a question.
Sure.
With so many life insurance companies to choose from, is there any advantage to selecting the provider affiliated with your mortgage lender?
Not necessarily, and I would caution you to, especially with first-time home buyers, often you're offered creditor insurance from your lender. Now, the key difference with creditor insurance, if we go back to who the parties to the contract are, with creditor insurance, the beneficiary is actually the bank or your lender. So the big issue is that if you were to die, the death benefit is paid directly to your lender, and they will use that to close out your mortgage. And it's also based on a group rather than your individual, risk profile. Whereas if I were to take a term policy, the other issue too with creditor insurance, it's typically not portable, meaning that when you refinance, you can't take that policy elsewhere. So it kind of locks you in. And then since you're being treated as a group, again, think of your 1,000 graduates of your graduating class. I think I'm healthier than the middle guy, so I would rather be treated as an individual risk. So that's the big issue. The policyholder and then the beneficiary is the bank, so they're going to make sure they pay themselves first. Whereas if I have a term policy, I die, and my girlfriend gets the death benefit, let's say there's a big credit card debt that's 18% interest versus our mortgage, which is only 4.5% interest, they should pay down the credit card first. So you retain autonomy of the death benefit with your term policy. With creditor insurance, they are the beneficiary. They're going to get paid directly by the insurance company, and they're going to pay the mortgage first. So definitely look at that, because you could probably find a better deal and one that's more amenable to your needs. Feel free to reach out. There's a really good handout that Raymond James has. It's a bit later in my presentation here, but very good question. Other thing is they cannot do what's called tied selling, which is to require you to use their insurance. They can say you should have insurance, but you could go to anybody else and we can look and compare quotes, and I'm sure you'll find a better deal elsewhere. But great question. So be cautious of creditor insurance for sure.
Jordan, correct me if I'm wrong, but also from my understanding, a difference between the lender policy and a term policy that you take yourself is that the one that's linked to your mortgage, for example, the policy the amount will decrease over the years as your mortgage is paid out.
Yeah.
So your coverage goes down and down every year, as opposed a term policy, like for example, you take a T25, so 25 year to cover your 25 mortgage period, the amount will remain stable.
Yeah. So there's a number of different types of policies that are out there. It depends. So each contract is different, but what we're describing here is called, so you can have level coverage, which means I have $1 million coverage for those 20 years. I'm always going to have $1 million coverage. And that's factored into my premium. My premium always stays the same. But you can also get what's called decreasing term, so that your coverage is decreasing over time, but you still say you'll still be paying the same premium, just the premium has been calculated at the beginning, knowing that you're going to get less. So this is a way to reduce your premium and manage it. If you know, okay, I have 20 years of coverage, my mortgage is also 20 years or 25 years, but I'm going to be making payments. So my liability is decreasing. So you can use decreasing term. It's not good, not bad. It's just a way of managing the premium. There's also what's called increasing term, where the coverage can increase over time. And again, the premium will be fixed, but that one will be higher because it's going to increase over time. So yes, you need to look at how the insurance is structured for sure. But those are different ways you can kind of play with the cost of the premium to have your protection, and also manage it based on cash flows. Another big thing, which I'll mention as just an insider tip, is you have the option to pay monthly or annually. If you pay annually, it's a net cost less than monthly. However, you know, for cash flows or budgeting reasons, some people, they need to pay monthly and they want to do their $15 every month as opposed to just one shot at the beginning. That's fine. Again, it's contextual, it's case by case basis. It's based on your budget and your cash flow. So me personally, I'll tell you right now, I'm doing a level temporary term for the course of my mortgage, and that will just give us a little bit extra in case something does happen. But it's not the worst because I'm fixing my costs anyway. But yes, good question. So again, decreasing term, it's going to cost you a little bit less in premiums. Level, it's going to stay the same, and then increasing would obviously cost the most for the same time period. Paribus.
Perfect. Thank you for clarifying.
No problem. I hope for everybody at home that was not too quick, not too anyway. So single life is like the name suggests, it's just protecting one life. Joint first to die is on 2 lives, and it's paid out when the first of the 2 lives dies, and then joint last to die is paid out on the second death. So why would we do joint policies? You can kind of average out the health profile if you include husband and wife, let's say. And then again, in terms of matching assets for when they're going to be consumed, it's usually on the second death that we're concerned about the tax liability hitting. Because as we mentioned earlier, for registered accounts, principal residence, you can do a spousal rollover, meaning there's a tax deferral opportunity, but it's really when, you know, it's typically dad who dies first. I'm just going to tell you, dad dies first, mom dies, and then when it goes to the kids, that's when we trigger a lot of tax liabilities. So that's why we do a joint last to die, because an insurance will kick in on that second death when all those taxes are hitting us. And again, you can kind of manage your premium by combining the health situation. You know, maybe Mr. smokes and Mrs. does not. He's much older, she's much younger. You're going to get kind of an average, which again is going to help you manage your premium and match it up for when you need it. So here's a nice illustration by, yeah, sorry, go ahead, Marc-André.
And when you say joint, does this apply only to married couple as an example? How do you define joint?
It does not necessarily need to be a married couple. It's just the 2 lives that you're putting on as the lives
Okay.
insured. So let's say I have a property with my sibling. You know what I mean? It doesn't necessarily need to be a spouse. It's just 2 people, excuse me. But yeah, that's the idea. As opposed to 1 life, there's 2 lives, and then it's for the insurance company whether they pay on the first death or the second death. That's the distinction.
Thank you.
Yeah, no problem. So this is a nice little illustration by Sun Life, and basically you have the traditional approach up on the top here. We are also portfolio managers, so there's always this argument of where you allocate your money to accumulate and save and invest, et cetera, et cetera. So life insurance is another asset that has different properties, and it should fit somewhere in your toolbox, so to speak. Here's just illustrating how it can be advantageous. If you're just rolling a non-registered account each year, there's going to be taxes payable when you're buying and selling certain positions. And then you also have to pay your portfolio manager's fees over the years, which is deductible, just so you know. But then you end up having a bigger liability on death here. So we would pay a higher percentage of tax. Now, on the bottom half there, if we were to invest in a permanent policy, this is specifically a perm policy because we have a cash value here. There's no growth within a life insurance policy. It's what's called an exempt policy. There's a complicated way of how they do that, but basically they look after 7 years. If there's too much growth, they'll say the policy's offside. We take some out of the investment portion and keep it on side. But basically, when you have a permanent life insurance in force, you can use it as collateral for a loan. You can take a policy loan from the insurance company, or you can withdraw money from that death benefit, and then it just kind of gets deducted from your payout later. But the idea is here, as you can see, it's paid out as a tax-free benefit to your beneficiaries. Again, it bypasses probate, and it's just going to decrease your net tax liability on death. And then also, again, we talk very casually about death, but it's a very difficult and emotional time for people, having to, find paperwork, get the act of death, close accounts, et cetera, et cetera. Again, it just creates a certain ease of administering things when there's liquidity on hand, and you're not having to sell positions here and there or sell properties and maybe sell them at a discount just because you have to deal with it at that particular time. So here's a few other just real quick tips about managing premiums. Buying a policy earlier is going to save you money. It's actually, you cannot insure someone until they're 15 days old. The reason is because the mortality rate is extremely high for infants. And then at age 40, our risk of disability and death drastically increases. So you can see there, it really picks up around 40, 45. My takeaway here is just, if you're looking to insure, it wouldn't be a bad idea to get a temporary now, lock in a deal when you're younger, because it's only going to get more expensive. That's it. That's how it works. The next point I would highlight is not smoking will save you a lot of money, or quitting smoking will save you a lot of money. You see here at the top, our worst smoker is going to pay about 10 grand more than our best case. And that's simply because their time horizon for potential premature death is much shorter. So the insurance company is theoretically going to have to pay out sooner. So smoking is a big one. There's a lot of actuarial data that we know from tobacco companies. So this is a big one. And then also on the topic of life insurance, since women live longer, they get lower premiums because, again, their time horizon is longer than men. This is actually the reverse with disability insurance, which is a bit counterintuitive, but women have a higher propensity to become disabled and stay disabled longer. So for disability insurance, women will actually pay higher premiums. So again, get in the game earlier if you're thinking about it, and then manage risk accordingly. We talked a little bit about this earlier. This is your creditor insurance. I will distribute. There's a very good handout from Raymond James that explains the difference here. But main things is you don't really control that death benefits. You can't refinance, lack of portability. And then again, they're insuring risk based on a group rather than you as an individual. So you would typically, most of us, rather be, rated as individuals. Next, we're going to just quickly explain what disability insurance is. It's insurance to replace income in the event that you become disabled. That is to say, you're unable to work. Typically, you can insure 60%, a maximum of 60% of employment income, which is received tax-free. The reason they don't want to let you insure 100% is they want to not encourage people to become disabled and just stay on the policy. One caveat here is that investment income is excluded because it's really earned income. You can still get investment income even if I, can't work. So this is not included in the calculations, really like earned income, if you like, from your employer. And this is of particular concern for self-employed individuals because most of us have some sort of safety net through our employers, some kind of protection, short-term or long-term disability. But where you're self-employed, I find a lot of people do not get any protection for this. And if you're, a self-employed photographer, for example, and you can't go out and work, this is going to be a big gap because you're going to have expenses, presumably more because you're disabled and you're not able to generate income. So self-employed individuals really should look into disability insurance. Most policies will not cover you past 65. It makes sense. The risk of disability is going to be very high past 65. So basically you can get coverage that will replace some of your income until you're 65. Own occupation, I'm going to just talk about this. this concept here, this is only available for typically 4A, class 4A individuals. So these are like lawyers, doctors, accountants who are very low risk. And if they become disabled during the course of their work, they can collect a disability payment and not have to work another job. But if they do decide to work that second job, they can essentially double dip. So when I was doing my insurance training, the example that was explained to me is, let's say you have a dentist, okay, they fall, they hurt their wrist. They're no longer able to work as a dentist. So the disability insurance policy takes place. They're starting to receive tax-free income from the policy. Let's say the dentist wants to work as an opera singer because they also have the ability to do it. They can be the opera singer, and they cannot take this benefit away from you, the disability. So that's something to know, especially for certain professionals. Again, if you're self-employed, like a dentist or something, and all of your income stops, you do need a way to hedge that risk, because really what you're selling is your human capital or your ability to see patients, and there's a lot of, jobs that would pertain to this sort of situation. What is critical illness insurance? So it's insurance that provides liquidity in the event that you survive a critical illness. And the big four that we talk about most of the time are cancer, heart attack, stroke, and coronary artery bypass surgery. So that's like to repair the arteries after you had a heart attack, the ventricles that they repair in the heart. There are other critical illnesses that are covered. I've seen as many as the big 20, and then there's a laundry list of diseases that are covered. The idea here is that if you survive the illness, you get a one-time tax-free payment to the beneficiary, and you have complete autonomy on how to do that. So let's say I lose a foot and I have a $1 million payout. I can buy a wheelchair. I can go to Greece. I can do whatever. I have autonomy on what I do with that money. Once it does that payout for that one critical illness, it's over. It's done. But this could be used, for example, if someone knows that there's a history of a particular, cancer in their family, they want to hedge their bets and give themselves some liquidity in case it happens to them. I've seen also strategically a lot of parents will buy this for young children because the cost will be very low. And then when they turn 18, they'll assign it to them. The policy carries and the premium is extremely low. So again, getting in the game early will allow you to manage those premiums, and you can assign it when they're 18, do all kinds of stuff like that. So my final thought, which I always like to end with when I talk about insurance, is from Confucius. We have two lives, and the second one begins when we realize that we only have one. And if you don't believe me, here are the actual statistics from CISRO, which is the Council for Insurance Regulation of Ontario, and the LLQP program. So this is basically a chart that lays out your life expectancy. I don't mind telling you all that I'm 35 years old. So I'm going to find myself right in here. I've got about 46 years to go. And each year I get older, my insurance costs will get higher. The need for protection will increase likely if I have children. I'm taking on a home, which means I have a debt I have to service. So really, it's easy to think about things when they're going very well. But actually, my first job was in civil litigation. We worked in personal injury. And I can tell you, when something goes wrong, it can really go wrong. You don't need to be rich. You don't need to be poor. Managing this risk is very important. So I'll quickly just show you a disclaimer about our presentation today. You should obviously consult a tax professional for any specific questions. We're happy to speak on a one-on-one basis, and happy to provide any of the figures or sources for any of the graphs I included today. But I will now open it up for some Q&A as promised. Here is my contact information if you want to reach out separately, but also happy to answer any questions now if there are any.
There's one, Jordan.
Yeah, we do have one question.
Okay.
So the question is there a general guideline or a rule of thumb to estimate the appropriate amount of life insurance coverage, such as a multiple of your annual salary?
Not necessarily a multiple of annual salary. We could sit down and kind of assess your tax liability at death. There's a number of things you can do. There's probate calculators and stuff online. But if you just look at, for example, your investments and your unrealized gains, that will give you an idea of like what's going to be triggered from the deemed disposition. If you have a bunch of real estate property that's outside of the principal residence exemption, you can kind of assess again, like I bought it for X dollars, which is your adjusted cost base, and then see what fair market value is now. And let's say you got it for 100,000, your confidence $1,000,000 now. Well, that's $900,000 capital gain. 50% of that is taxable, or 66, depending on what happens with Parliament in the next few months. I won't pronounce myself on that. But there are ways that we can actually assess your insurance needs and make sure, because a big part of our job is to not overinsure and not underinsure, but to actually match the products with the client's needs. So as you get older, maybe you add more assets, which increases your tax liability. But we can basically assess that. It's not necessarily a multiple of income or anything like that. It's really looking at the assets you have now, because if you're just in cash and you have nothing where there's going to be a deemed disposition or relatively low tax liability, you don't need as much insurance. Whereas if, like I mentioned, you have that generational cottage that's been there for 40, 50 years, and you know there's a big capital gain coming, or I've seen with some older families, like grandpa bought Microsoft stock in the 80s and he just held that position all the way through. There's a big capital gain, whether you actually sell it or not. There's just that deemed disposition we mentioned earlier. So grosso modo, we could assess that for you and explain like how we came to that conclusion. And part of it is also to do it on an ongoing basis as you add or subtract assets from your balance sheet. But it's a good question. We will conduct a needs analysis for you when we go through the application process.
I think also we should have a look at, if there is any people around you that are financially dependent on you. So
yeah, that's also a big factor. If, for example, you have a child who's infirm, you can combine that with a Henson Trust. For those of you who don't know, Henson Trust is a trust that distributes assets without putting a mentally incapable person or somebody who's eligible for a disability tax credit over their allowable thresholds for provincial or federal assistance. So it was actually came up in Ontario. An older gentleman willed the stuff in a trust to his daughter. The government said that would prevent her from having entitlements, but basically the Henson Trust gets us around that. But yes, certainly needs analysis will involve the particular parties at play, how many children there are. Some are more self-sufficient than others. These are all factors that we come into. And also it's just the desire of the client. It's a very big part of your estate planning, and it's how does the client want the assets to be distributed. Again, it's a case-by-case basis. Maybe one kid's very successful, one kid's not. We can always do distributions to beneficiaries that aren't necessarily equal, but they're still fair. We talk about that a lot in estate planning. Equal versus fair is not always the same thing. So yeah, needs analysis is done on a case-by-case basis, taking into account assets as well as the people around the client.
Thank you, Jordan.
Thank you. So far we don't have any more questions, but maybe we can talk about the question was about life insurance, but maybe we can discuss it for disability insurance.
Sure.
So in my opinion, like for disability insurance, obviously it's a case by case, as Jordan said. But when you get disability insurance, it's usually to insure your human capital, right? So instead of insuring a death penalty, it's really the impact of not working for a very long time due to a disability. So usually a rule of thumb would be to insure the amount that your cost of living, basically. So if you were to have no additional income, all of your usual spending, your cost of living would be covered for. I don't know if you have anything else to add on this, Jordan?
Yeah, no, for sure. As you you hit the nail on the head there, really, disability is hedging a different risk, because it's if I get hurt and I don't die, right? So I still have to live. Even if you're 40 years old, right? You're 25 years out from retirement, let's say. I did a quote, I'll be honest with you, for my brother, who is an electrical engineer. And so, basically I said, you know, even if you end up paying these premiums for those 20, 25 years that remain, the risk really, if you become disabled, so A, your income stops. B, he happens to be a shareholder in a private company. I've read the shareholders agreement. They will force him out. C, he will not be in the best position to negotiate the value of those shares or do the transition to convert that to cash. And then thereafter, what's gonna be his source of income? So especially with self-employed people or people who really are selling their hours or using their human capital, it's a very big threat to your financial well-being because income is just going to stop, and it's unlikely you're going to be able to find a new occupation that's going to match that or surpass that. And with like factors like inflation and stuff like that, it's going to be a real drag. So disability insurance is really for that. I got hurt but didn't die, which is very important to understand. And then the other factor, as I mentioned in the presentation, is they will only let you insure a certain amount. So typically it's 60% if you're receiving it tax-free. So if you're paying with after-tax dollars, they'll cap it at 60%. It's partly to not motivate people to get on disability. The other part of that is also, excuse me. The other part of that is with disability insurance, you need to buy what's called well, you don't have to, but you should buy what's called a future purchase option. So basically, you have to show how much you're making now to justify I'm going to be protected for 60%. But you also, let's say, if you're making more money in 10 years from now, you want to be able to increase your coverage. So with disability insurance, so we call that a future purchase option. So let's say I'm making $100,000 now. I can include a future purchase option in the contract. And if I exercise it and I can show I'm now making $250,000, they will allow me to increase my coverage. So that's a big issue. Disability insurance is tied to like earnable income. And I'll also remind you that caveat, it's not investment income. So if you have a portfolio and you're using that to plant your income, it's really just what you're getting from your employer that you can insure. It's not this investment sleeve over here.
Yeah. Thank you, Jordan. I feel like life insurance is very well known usually, but disability insurance is less talked about. And for most people, especially for self-employed, as you said, but even for employed people that work sometimes for smaller companies, that not all companies offer disability insurance. And basically everyone that works and earns income needs some type of disability insurance until they have enough savings to finance their lifestyle until that, basically. So usually the closer you are to retirement, the less need there is. And when you do get, if you were to be disabled and you obtain the money on a monthly basis, the payments will stop at 65. So you need to finance your lifestyle, but also your retirement, because it won't go until past 65.
Exactly. Yeah. You still need to budget for that time in retirement. And even if you're collecting the disability, as we mentioned there, it's a reduced amount. So your ability to save, there's going to be a drag there, and it stops at 65, which is another big thing. So just to touch on, a lot of people don't think about disability because they have it through their employer. I've read some of these contracts, and it's nothing against them. It's the plan. But usually sometimes disabilities it looks like it's good because it says 65 weeks. 65 weeks is not a very long time to protect your disability, especially if it's one that's going to prevent you work for the rest of your life. So oftentimes you can bridge the gap with private insurance. You can definitely probably speak to your HR, whoever administers your group benefits with your employer. But it is a huge cost, if we're being honest, for private businesses to absorb. And they're providing less and less, if I'm being completely honest with you. And that's even more emphasized with self-employed people, where there isn't an employer above them to maybe think about this in a kind of standardized way. But like the photographer example I used, your ability to go out and do your stuff is going to be heavily hindered. The other point I would like to make too is own occupation is not available for just anybody. I'll be frank with you. You can't get it if you're, I don't know, a firefighter or a construction worker, because your propensity to be injured is very high. And then the threshold is just you can't do construction work. Well, there's a lot of people who would not be able to do it. So that's why it's restricted to what we call 4A. It's a very low risk class. Your accountants who are at a desk, or doctors and stuff like that. So
Your
depending
portfolio
on
manager.
your portfolio managers, yeah. Hi, Mark. Have you done your life insurance? Shall we have a look? But anyway, yeah, no. So that is one thing to consider as well. Whether or not you're eligible for it, what form it will take. I didn't get into it, but there are different types of disability that's available to different types of workers that are in different industries and so on and so forth. But again, sometimes your employer is going to provide you with pretty good benefits. It's again, case by case basis. People want a quick answer, but maybe you work for a really big company that has great benefits and they really want to take care of their people. But it's something to look at. And certainly if you're self-employed, because there's such concentration in the value of your human capital and your ability to generate revenue, it's something worth looking at, especially young doctors these days too. You've paid a lot of money to get a medical school education. You're particularly vulnerable at the beginning because presumably you're carrying that big line of credit that you use to finance your education. So that's something to consider as well. But again, case by case basis, we can do a needs analysis. Happy to sit down and speak with anybody, and we can really assess what pieces we should put on the board to make the right move for you.
Maybe two last quick question for you, Jordan, before we go.
Sure.
You mentioned earlier that smokers are paying significantly higher insurance premium than non-smokers. If a smoker quits today, how long will it take for the insurance company to consider this person as a non-smoker now?
The real threshold is 24 months.
Okay.
I did a policy not too long ago, and they do want to know as late as 5 years ago. And basically, just so you understand, when you're doing an application for an insurance policy, they can order additional medical tests, which will allow them to underwrite it. And they can test for nicotine in urine. So if you say it's been 2 years and that's the truth, maybe they'll check, maybe they won't. But it's really impactful where it's been in the last 2 years smoking cigarettes. But again, the questions may include more, and then that may lead them to ask more questions. But if you can get that down 2 years, they'll vastly impact the cost of your premiums. The other thing to mention is once you've entered into a life insurance contract, they can't increase the premium, but they can decrease it. So let's say I enter the policy, I'm smoking 2 packs a day, et cetera, et cetera, et cetera. But I quit. I do it for 2 solid years. My doctor confirms it. They even check my urine. Okay, there's no nicotine. He's telling the truth. They can decrease your premium, but they can't increase it. And there's actually a trick question on the LLQP exam. You've got 2 twin brothers, okay? Alfred and Bob. Alfred is a non-smoker when he starts. Bob is a smoker when he starts. Alfred starts smoking after entering the policy. Bob stops smoking. Whose premium can we adjust? So it's a bit counterintuitive. You think that we can charge the smoker more, but we can't. We've already locked in a contractual agreement. It's Bob, who's now a lower risk, who can go back to the insurance company and say, hey, I'm not a smoker anymore, therefore my risk needs to be readjusted. I'm going to live longer. And just also, I have read many places that for anybody looking for a reason to quit smoking, if you're able to quit before 40 and just stop, the bronchioli in your lungs can actually recover if you stop at 40. But after that, it's really, even if you quit at, let's say, 45, the damage is too extensive that to come back is much worse. So again, I'm not an anti-smoking advocate, but just for practical reasons, you can manage your premium, you make your life longer, you decrease your chance of heart attack, stroke, et cetera, et cetera, et cetera. And then, there's lots of reasons you should quit smoking at the end of the day.
On that topic, because you mentioned like nicotine and cigarettes, but I know a lot of people nowadays vape. So that would count as smoking as well.
That would absolutely, because there isn't as much actuarial data on vaping. Obviously, it's a relatively new concept, but they kind of treat it in the same category as tobacco products, obviously. Cigars get treated a little bit differently. But certainly cigarettes are the big culprit, because we have a lot of data on it, and we know the extent of the damage it can cause. But the other thing I will mention too is to always be as honest as you can when answering an insurance application, because nothing would be worse than you making a representation that's incorrect and then later they're saying you failed to include a piece of information which would have affected our underwriting decision. So we're gonna, void the policy. So there's a couple deadlines actually I want to mention in connection with when a policy is enforced. Not a lot of people ask this, but there is a suicide exclusion for a life insurance policy, which is 2 years. So let's say I took out a policy. I have to wait 2 years before it will protect me in the event that I take my own life. So even if it's 2 years and 2 days, if I take my own life, the policy will pay out. If it's within the 2 years, they do not have to pay the claim. I'm not suggesting anyone use this as a planning tool, but that is the regulation. The other thing too to keep in mind with the policies is because of anti-selection, which is a concept of people when they know they're sick are more likely to take insurance. There are waiting periods for certain diseases. Like let's say a policy is enforced, there might be a waiting period of 30 days. If you find out you have cancer or something within those 30 days, they're going to kind of surmise that you had an inkling that you had cancer and it might not be covered. So a big thing to look at is when these timelines actually kick in, because there are some exclusions, which a lot of people don't know. The other thing too is there's what's called the contestability period in the first 2 years. And that's if they find out something that would have affected their underwriting decision in the first 2 years and they found that you willfully concealed it, they can void the policy. If it happens after 2 years, it's on them because they didn't do their due diligence, let's say. But that's something to keep in mind. And then the other thing is when you do an application for life insurance, you basically agree to a bunch of terms in user agreements. A lot of us don't read, but your medical information goes to what's called the MIB, Medical Insurance Bureau. It's encoded so that they don't know it's Jordan, but like it has a profile of a guy my age, et cetera, et cetera. So let's say ABC Insurance denies my application because I tell them I've had cancer in the past. But then I go to DEF Insurance, do the same application, and don't tell them that I've had cancer. This data is already in the MIB, and all the insurance companies pay a subscription fee to get access to this information. So you can't. It would be very difficult to fraud the insurance company or withhold information. So anytime you're doing one, just be honest. Don't try to conceal any information. Answer the questions completely and honestly, because there'd be nothing worse than if the policy gets accepted and then there's something that happens later that will void it. You've paid into these premiums, and it's a big waste of time and money, essentially.
Thank you so much, Jordan. So we have only a couple of minutes left. So I guess I'm just going to wrap this up. So I think the key takeaway here is to understand what the risks are, understand the products, try to find out what your existing coverage is, and the additional coverage that you need to really match the risk. We're here to help. You can contact us, no problem. I think it was really insightful. So thank you very much. As a reminder, it will be recorded. We will share the recording by email and on our social media platforms. So LinkedIn, Twitter, and Facebook before the end of the month. And we'll be having, I believe, 6 more webinars until the end of the month. So please join us and ask questions. We're always happy to have you and participate with you guys. So thank you, everyone. Have a great day.
Thank you very much.
Have a good weekend, everybody. Bye.
Bye.